Good morning, everyone. Thanks for joining us this morning. Darius Dell here to present our Macro Bundle live Q&A. I'm joined by our friend Mitch Anderson, a portfolio manager at Solidarity Wealth. He's put together a wonderful slide presentation with you guys on asset allocation, portfolio construction, in terms of how they implement the process over at his new shop. So without further delay, let me kick it off to Mitch.
Yeah, thanks, Darius. Hello to everyone on Team 42. Happy to be here. Thankful for Darius inviting me to be on this Q&A. I have put together a slide presentation that I hope will be beneficial to those in the network who are wealth advisors who may want to see how to use some of the 42 macro signals in their portfolio construction. And also, I know there's a lot of do-it-yourself investors out there that, like myself, if I wasn't doing this professionally, I would do it as a hobby, probably all day, every day, because I love it so much. But I do have some slides here that I thought I'd share as visualizations for everybody. And we'll take 15 minutes, maybe 20, to get through these. And I'd like to share one way that I view the markets and one way that I view portfolio construction and how I construct portfolios. So first, I wanted to share this formula. This is the total return function, and this comes to us from our associate, Bridgewater, and our mentor Ray Dalio. If you Googled the Bridgewater all-weather story, you could read an article where this formula is found. But one way that I view the markets and that I view portfolio construction is I view an investor's total returns, or their returns are a function of cash plus beta plus alpha. For those of you who already know what beta and alpha are, hopefully this will give some thoughts on how to construct portfolios. For those of you who get frustrated when someone like myself or Darius talking Greeks, we're going to explain what these are as we go through this. So we all know that cash, fiat cash, is controlled by central banks, and it's not a great investment over the long run and over time because it gets devalued over time. So we all know that cash is not a great place to be for a long time. Now, when you look at your beta, I consider beta to be, basically, your public market equity, equity and fixed income exposures. So that would be your S&P 500 or the SPY in the equity markets. I've also put in the traditional 60-40 portfolio. You can think 60-40, 80-20, 40-60, however you want to think about the equity to fixed income allocation. This is the traditional standard portfolio that the industry has been with for 20 or 30 years, created by Markowitz. Basically, is this Markowitz kind of portfolio. And the reason why I consider the traditional portfolio in the beta category is, one, this portfolio will outperform cash over time. So from this article, we learn that betas in aggregate and over time outperform cash. There are few sure things in investing. That betas rise over time relative to cash is one of them. So there's few sure things in life in general, and especially, in investing, there's very few sure things. But if you could bet on one sure thing, that is that your beta will outperform cash over time. So this traditional 60-40 portfolio does that. Over the long run, if you weather, the ups and downs of the economic and the debt cycle, this portfolio will outperform, cash over time. And I think that's helpful to understand, because in times of stress, when the 60-40 portfolio doesn't do well, maybe in a deflationary market regime, this can help you stay invested and stay committed to your investment, goals and strategy, understanding that this portfolio will outperform cash over the long term, even if in the short term you have short-term hiccups where cash is king, right? In maybe a recession or a deflationary environment. I also put a 401k in here because that's basically, a mutual fund lineup that's basically your traditional portfolio. Another reason why I have it here in the beta category and not necessarily the alpha category, and we'll get into this a little later, is because this portfolio has limitations. It's sensitive to left tail risk. And because of our low interest rate environment, it's not, investors are getting pushed further and further out on the risk spectrum. It may not be as diversified as people think, or as diversified maybe as it used to be. So when you think about, your returns in your portfolio, when you think about alpha, think about people capturing risk premiums, think about, a disciplined trading strategy. And I also think about 42 macro. So as a professional in the industry, I rely heavily on Darius and on 42 macro to help add value and implement some of the alpha, strategies that I've created and am implementing. I really rely on 42 macro to help me do that. But I also think that you can use 42 macro within your beta portfolio within the traditional 60/40 framework on the asset allocation side. And that's where I'd like to spend, some time today. So thinking about, your beta portfolio, we all know this from Darius, the 42 macro asset allocation framework. If you apply this to, the traditional 60/40 portfolio, you're going to have your traditional asset allocation. You're going to have 60% equity, 40% fixed income. And within your equity, it's going to be broken down typically at any shop. I've worked at a couple of shops. They typically break it down with the lion's share of the asset allocation being in the USA large cap, which is basically the S&P 500. But then you're also going to have, exposures to the small cap and mid cap space, your international developed space, and your emerging markets. And this is typically, how the asset allocation typically looks and it typically works. On the fixed income side, obviously you're going to have treasuries, you're going to have your corporates, investment grade and high yield, and then your alternative sources of income. I put in here, the Goldilocks, reflation, inflation, and deflation categories, depending on, where the asset class thrives relative to the grid regimes. So emerging markets obviously do very well in Goldilocks. International developed does very well in reflation, given that the international markets are pretty cyclical. And, the small and mid caps obviously do well in Goldilocks. Now, I know on the back test from Darius that inflation and deflation are kind of awful regimes for equity markets, and the S&P 500 doesn't back test that well in these regimes. But you should know that on a relative basis, think about, the S&P 500 being one of the most liquid, probably, it is the most liquid equity market in the world. And when the liquidity dries up, which tends to happen, especially in deflation, on a relative basis, this asset class most of the time has outperformed some of these more cyclical and risky areas of the market. So that's why I put inflation and deflation as a representation of the S&P 500. Obviously, your treasuries do well in inflation and deflation. 60/40 portfolio inherently is pretty underweight treasuries, actually. I think it's pretty consensus that in order to beat the aggregate bond index, which is 2/3 treasuries, has a 6.5 years duration. If you take on a little bit of credit risk, you should be able to outperform the aggregate bond index over time. So a lot of these portfolios, they often don't have that much in treasuries, especially long duration ones. And they're oftentimes loaded up on, corporates and alternative income, which does well in Goldilocks and in reflation, but in times of stress, when liquidity dries up in these markets where people are banking on a liquidity premium, these asset classes don't do as well. So this is your traditional, asset allocation. And I wanted to walk through an example and an exercise on how you could use the 42 macro signals to help construct an asset allocation in this standard portfolio, both for yourself, maybe in a 401k, or for professionals that are doing this professionally. This graph represents the U.S. markets versus the international developed markets and their sector weightings. Okay, so here in the blue bar graphs represent, the U.S., the S&P 500, and their sector weight and their weightings in all these different sectors. The orange bar represents the international developed markets, or IFA, and the yellow bars are the difference between the two. So you can see that where the yellow bars are coming down, that is where the international markets are more heavily weighted to the U.S. And this is a top-down analysis in order to make, some of these asset allocation decisions. But you can see, basic materials, international has a lot more exposure to materials, a lot more exposure to financials, energy, and industrials, which are actually a pretty cyclical industry and sector. And all of these sectors benefit in the, they do well and they lead out in the reflation macro regime. And so, one way, you could think about, at least that I did, in fading some of the reflation regime that we think is a low probability outcome going forward for the next year or so, is, you could underweight, your international developed markets relative to some of these other markets and sectors that do a little bit better and inflation and deflation. So something I wanted to point out especially is the technology sector. The technology sector, that's where a lot of the growth companies are at. And when you hit, the inflation macro regime, when economic growth, starts to slow down, investors will pay up for growth where they can find it. And the technology sector actually does pretty well in the inflation, regime. I wanted to point out that the S&P 500 has over a 15% overweight in technology relative to the international markets. So I think that's important to understand when doing your asset allocation, and if you want to be tactical or strategic at all in your asset allocation framework, you should know, you can do this in all the different asset classes and markets, but you should know how their sectors line up. And so, yeah, I guess this would be, one example is if you wanted to fade the reflation regime, which a lot of us have, you could underweight your IFA or your international markets in favor of maybe the U.S. markets. Yeah.
And I sort of consume a lot of financial media and kind of keep my fingers on the pulse of what's consensus. International over US is very much consensus heading into 2022. Obviously, there's a sort of COVID recovery story that seems to be lagged internationally, particularly in emerging markets relative to our economy, that investors want to bet on and participate. But this, just based on the C of Ds that we have projected for next year, this would seem to suggest that is going to be a losing bet. So this is really brilliant analysis. Thanks for putting this together.
Yeah, no, I would suggest, the international markets are much more cyclical than the U.S. markets. The S&P 500 and the U.S. markets are much more, growth oriented and somewhat defensive oriented. When you look at their betas, there's a higher risk premium overseas. And I think that's been consensus for a long time, Darius. Actually, I've been in the industry for, professionally for 8 years, but, I have a dad who's a financial advisor. So I kind of grew up around, the 2005 to 2008, when China and international really erupted. I think that generation is kind of hung up on that and that providing diversification to your portfolio. But, from my models that I've built on a bottom up standpoint, the earnings growth is just not there in international markets. And if the economy is going to slow next year, investors are going to pay up. There's a time when you might want to own, expensive stocks if they're expensive for a good reason because of their earnings growth and quality. So, that's a good thing. Thanks for pointing that out, Darius.
Yeah, we agree with that. Thank you.
So yeah, on your posterior 60/40 portfolio asset allocation, if you had made that, asset allocation adjustment, you'd have more exposures to the U.S., less to reflation. You'd obviously have a lot more exposures to your treasuries relative to your corporates and your alternative sources of income. And I also put in here, a reduction of the small caps who get punished in the inflation and deflation regimes in favor of potentially putting that into emerging markets, mostly because of China's dominance in the whole macro world, but also in emerging markets and its expectation to recover and reflate here in 2022. Darius, feel free to chime in here on your thoughts on China and emerging markets. I'll quickly say that, in the macro world, you have two big players. You've got China and you've got the U.S. as the two biggest economies in the world. And, I'm laser focused on China because they lead the world in recoveries because they're so aggressive. They have been, and they have been historically, they've been so aggressive on their monetary policies and on their stimulus that you've had to pay attention to China maybe over the last 10 years in order to understanding when a recovery and a reflation is going to happen and occur because of their dominance in the world, in world trade, because of their size. China tends to lead out in recoveries, while the U.S., if you think about it this way, tends to lead out, somewhat in recessions. So when you think about, a recovery, or you think about coming up, on the sine curve, you have to pay attention to China. But I will say they have stated and said that they're going to be more prudent, right, with their monetary and their fiscal policies. So, even though China is expected to rebound and to reaccelerate in 2022, I'm not quite convinced that trade has legs. So because I already have exposure to China and to emerging markets, I'm not quite sure if I'll make that decision to go overweight in the emerging world because I'm not, in taxable accounts and stuff. I'm not sure that trade has significant legs relative to the U.S. markets, maybe to international developed. But yeah, I don't know, Darius, do you have any thoughts on China for 2022 and on emerging markets, going
Yeah,
forward here in the near future?
great analysis, man. You sort of in terms of the trade having legs, I would tend to agree with that. This is one of the key takeaways from my discussion with Leland Miller of China Beige book a couple weeks ago, which is sort of he's seeing a lot of the same sort of macroprudential easing that we're picking up on, and also obviously the broader monetary easing that we're picking up on in the last couple of months. Oh, sorry, I was saying he's seeing. This goes back to my conversation with Leland Miller of China Beige book with Real Vision a couple weeks. In terms of what obviously they have a lot more data and a lot more feet on the ground in terms of observing the policy impulse in China. But we're observing a lot of the same things with respect to the macro prudential easing that we're starting to see in the real estate sector. That started early in December or late November. We've seen a little bit more monetary easing out of the PBOC in recent weeks as well. And so, it's very likely that we are putting a floor in Chinese growth, and Chinese growth is set to start to recover as the base effects really start to wane, kind of mid Q1, late Q1 of next year. The issue with that, and this is sort of one of the key takeaways from that discussion I'm highlighting, which is, this is very unsustainable in terms of, kind of, the prior growth model with respect to China. They're effectively they're easing off the brakes and they're not slamming on the gas. And this is it's a very different policy response to an economic slowdown and a credit contraction that we're seeing out of PBOC and out of Beijing. And that what ultimately means is if they don't find a new sort of sector to drive growth forward, beyond 2022, we're going to see another material slowdown on the back end of that. And ultimately, the kind of punchline of that whole discussion was that investors are not yet ready to acknowledge the fact that the structural growth rate in the Chinese economy is likely significantly lower as a function of these sort of policy initiatives than we otherwise have gotten used to in the last kind of 8 to 12 years. So that's kind of the key takeaway there. So yeah, I would tend to agree the trade doesn't have legs, but obviously they're kind of early innings of the trade and not latter innings.
Yeah, I mean, I know that you recently put, China in, your portfolio construction. And, from an asset allocation perspective, I think if you wanted to be tactical, you could, make that call into China. From a longer term strategic perspective, I have not made that decision, in client portfolios because I don't need to be early. I don't want to be early in case, that recovery tends to be a head fake and then really go down. I don't need to be overweight in a riskier asset class like emerging markets
Yeah.
if that doesn't actually occur. So I'm actually, kind of waiting. Some of my bottom up fundamental models that I've built have been giving me a signal on China for the last 2 or 3 months, looking at valuations and growth rates and expectations, for the sustainability of the companies that exist over in China. But I've been waiting on you to give me the signal to really pull the trigger to overweight assets in China. And I'll be waiting on that probably till February or March. I need to see the trend actually happen, and I need to see it occur before I can make that asset allocation decision. But again, I already have exposure there, so I may not actually, pull the trigger and make an overweight decision. It's something I'm still evaluating.
Yeah, no, and I don't think we're ever going to get to a place where China is going to be overweight relative to the U.S. or relative
Yeah,
to other asset classes in the portfolio construction, just given the high beta nature of this asset class. We're actually, if there's one thing I've been saying for the last 6 weeks, or really going back to the kind of the early part of November, which is reduce your exposure to high beta assets, high beta risk assets, high beta assets in general. That to me is going to be the name of the game as we progress throughout next year, which is we're gonna investors are going to consistently encounter, in our opinion, pockets of illiquidity in trying to go from one side of the boat to the other. And what I mean by that is getting out of high beta and into lower beta. You might get as we've been talking about in the morning note in recent weeks and roasting around the horns. We're likely to get an opportunity for those of you on Team 42 who've not fully sort of bought into the downshift to low beta and the upshift in quality in your portfolios to really get an opportunity to make some of those pivots. But beyond that, I'm not really sure you're going to get a really good opportunity as we kind of get later into next year.
yeah, and I think long term, if you're worried about, some of the structural growth in the international world, something from international to China and EM might be interesting too, long term. But that's something you have to decide, on your own. Yeah, lastly, I wanted to hit on some of the limitations of the 60/40, the standard portfolio. I created this slide, but a lot of this content comes from Diego Perea in his book, The Anti-Bubbles. I think he has a lot of good things to say. He has a good investment product, actually, an alpha product, to offset some of these limitations of, the 60/40, the tail risks that exist in the portfolio. But he says, from risk-free interest to interest-free risk, the search for yield has created one-way portfolios that the government and Federal Reserve must support in times of crisis. So this creates portfolios that provide, somewhat of a sense of false diversification that are at risk of global Syconius bubbles. So if you look at these asset classes like, U.S. equities, all the way to high yield credit, all the way to government bonds, they basically represent various degrees of, the exact same trade. So they all benefit from and basically need, the dollar to get devalued. They need falling interest rates. They need falling volatility, and they need their correlations to stay intact, which we know does not happen in times of stress. I think March 2020 was a microcosm of that, and what may happen in the future, a little more, with everything basically correlated to one. When these things get unwound, the desperate search for yield has created monetization of volatility. I mean, I do this all the time. And I'm exploring ways to do it for clients to generate alpha, in their portfolios. But when the volatility spikes and gets unwound, when interest rates rise, when the dollar is strong, that puts a lot of stress on, the 60/40 portfolio, because we're at the lower bound. Some places are even negative in interest rates. So people are getting pushed further and further out on the risk spectrum. And when that gets unwound, you can get pretty violent moves in the markets and within the 60/40 portfolio. The standards, portfolio, it does not work well in the negative tails of the distribution function. So here's your distribution function. Here are your fat tails. Something we've learned, from, various investment professionals and mentors is these fat tails happen a lot more often than the bell curve predicts. And when they do happen, this portfolio, tends to, Darius has mentioned too that, you subscribe to 42 macro to avoid, to try and mitigate these risks. And, the standard portfolio will go through 15, 20% drawdowns once every 5 years, 2 or 3 times every 10 years. That does happen. So I personally, in my profession, in my personal, investments, use the 42 macro framework to help offset these tail risks that exist in the standard portfolio. And I quickly wanted to go over how the portfolio looks in these different grid regimes. Obviously, in Goldilocks and reflation, this portfolio thrives and does very well because it has exposure to emerging markets, international, small caps, high yield. 2017 was like a year when emerging markets really ripped and did well. Yeah. And then, in the first half of this year, we saw reflation do really well, we saw the portfolio do pretty well because it has exposure to international developed and U.S. value and short duration bonds. The street or, advisors, they always think interest rates are going up always, and they're always worried about duration and duration risk. So they never want to have long duration, and especially long duration treasuries, which actually work pretty well in an inflation regime when the yield curve starts to flatten. So I would suggest, in the inflation regime, the portfolio, the standard portfolio survives. It doesn't do well because it doesn't have commodities. It doesn't have long duration treasuries, but it does have a heavy allocation usually to the S&P 500, which has tech, which has a lot of the FANG names, which are somewhat insulated from inflation and actually benefit from an economic slowdown because they're growing in excess of the economy. So the portfolio survives, in inflation, but it really struggles in deflation as we've seen, historically in other times and in the back tests. And that's because the standard portfolio, it doesn't have cash or, currency as an asset class. They don't own enough treasuries because they're trying to collect that, that credit and that liquidity premium in the fixed income markets. And they don't own gold very often or very defensive assets. So, over time, as I explained, that standard portfolio, that beta portfolio will outperform cash, but it really needs Goldilocks and reflation in order to look good and to work really well, as it doesn't work down here. So that's where, I come to, to the alpha portfolios. So from the Bridgewater all-weather story, they say that the characteristics of betas and alphas are distinct. Betas are few in number and cheap to obtain. alphas or trading strategies are unlimited and expensive. So if you can generate alpha and you have a process that consistently can do it, it tends to be expensive, and a lot of people tend to offer it. So yeah, this I wanted to walk through a little bit quickly what alpha is, because I think even in the industry, I've met professionals who don't understand what alpha is. I mean, they know that it's good, they know that they want it, and when it's positive, that's great and helpful. But people have a misunderstanding about what alpha really is, and mathematically, this is how it looks and this is how it's framed. But the simplest way that I could describe it is that alpha, its returns in excess of the systemic risk that was expressed in the portfolio. So for example, if the market returned 10% and an individual's portfolio returns 12%, but they had a beta of 1.3, because of their risk in the portfolio, they should have generated, a 13% return, but they only generated a 12%. So their alpha is actually negative 1%. So even though they did better on a nominal basis, on a risk-adjusted basis, because alpha is a risk-adjusted metric, they actually generated negative alpha, as opposed to a portfolio that generates an 8% return, but only had a beta of 0.5, they actually generated, 3% of alpha. So even though they underperformed the benchmark or the market, on a nominal basis, on a risk-adjusted basis, they actually did quite well. And I would suggest that this portfolio manager or this portfolio had a lot better, result, than this portfolio. So I wanted to explain that's what alpha is. So in thinking about your returns in cash and your beta exposures, I often use alpha portfolios, to offset some of those tail risks. And if you wanted to have alpha in your portfolios, you could hire a professional money manager who's trying to capture risk premiums. So think of your value manager, your growth manager, your long short managers, your private market allocators who try to, collect that liquidity premium. Or you can, I know there's a lot of you out there that are, love 42 macro framework and you do it yourself. I do this for myself and for clients. I have what are called risk management portfolios that are constructed to offset the tail risks of the 60/40 portfolio. And I see this as providing, an investor with, a holistic, diversification, because the 60/40 portfolio is sensitive to those and vulnerable to those tail risks. I've created some, portfolios that help offset, some alpha portfolios that help offset that. And they work, really well in retirement accounts because I don't have to worry about tax consequences. But there are ways to do it, in taxable accounts that I'm exploring right now as well. So, yeah, that's what I had, Darius. I'll share another slide, now or later. I don't know if you have any other thoughts.
Go back to the slide with the grid regime where the 60/40 portfolios were. Yeah, I'd see. This is what I think in a future state of 42 macro. You just put a brilliant idea in my head, which is create a product, either research or otherwise, through an ETF wrapper or something that allows investors to take advantage of the 60/40 portfolio, the simplicity of the 60/40 portfolio, through the context of the grid regime framework, right? I mean, you could be long, I don't know, S&P high beta and I don't know, the HYG and Goldilocks, small caps and I don't know, convertible bonds or BDCs and inflation, you can be long SPLV, treasury bonds or something like that, or LQD. And then lastly, obviously, if you're in deflation, DEF or something like that, and EDV or zero. So, kind of rotating in and out of those things, rebalance weekly or monthly relative to the forward probabilities for achieving each of those grid regimes. I mean, to me, that seems like a very obvious solution to some of you who may want to trade less and do have taxable account considerations in terms of the frequency which we make signals in the overall portfolio construction. So I'll definitely keep this in mind. And this is definitely, thank you for sharing this, because this is something I think would be an added benefit for a lot of investors.
Yeah, no problem. Yeah, I guess lastly, Darius, I wanted to share this with everybody, as a way to help people, use the process. That's the hardest thing I've come across in using the process, is the tax consequences as an investment professional. So that's why I kind of see, the 60/40 portfolio as your beta portfolio that you just let sit and accumulate over time. And then maybe in a non-taxable account, you have some alpha portfolios that can offset some of those risks that exist there to provide, holistic diversification. Um, so yeah, but I wanted to share this because I know a lot of people say you got to read the tape, you got to read the tape, and I think that's in the book, Reminiscence of a Stock Operator, which is, a great book. He says that all the time. But for the longest time, I had no idea what that meant. People are like, you got to read the tape, and I'm like, how do you read the tape? And one of the things that's helped me is this that you've created, Darius, is your month-on-month Sharp ratios. And to me, that's the current tape. That is what the market is pricing in right now. So for people who don't know what a Sharp ratio is, it's a risk-adjusted measure of how your portfolio, or how it's a risk-adjusted metric that shows your performance relative, to your standard deviation. But you can see in the current tape, our current market leading is healthcare, Apple, which is it's the largest component of the S&P 500. So I would suggest that's people moving to, more liquid markets. You've got, minimum volatility. You've got REITs. You've got consumer staples and utilities. That is most definitely an inflation or a deflation tape. That's an inflation or a deflation macro regime. So that's the current tape. But I use, these bottom up economic expectations we expect the market or the tape to price in what the economy is doing going forward. So the expected tape, for the next 3 to 9 months is expected to be here, in the deflation, macro regime, probably a toggle between inflation and deflation. And this makes total sense to me that here in December, we're in the inflation regime, from our bottom up macro perspective, and that is exactly what the market's pricing in today. So I just wanted to share that for people who don't know what that means, and also wanted to share how I use, some of your research, Darius, to see what the market's pricing in now and what the expectation is, going forward on, a 3 to 9 month window.
Yeah, that's a great call out too, because the reason I look at that so religiously is because I'm obviously trying to observe the current tape, but more importantly, I think it's important to notice when the current tape is changing, and if that change is either sort of consistent with what the projections are, or if that change is inconsistent with what the projections are. And so kind of one thing I called out this morning was the advent of two pro-cyclical sectors and style factors into the upper quintile. And so what we're showing in the chart there, the chart on the left is the upper quintile relative to the lower quintile. And the composition is what really matters, as we discussed in the intro to the process video with our friend Larry Baxter. So this sneaking into the upper quintile this morning was least shorted value and least shorted high debt. Now, those are obviously more safe areas within the context of procyclicality, but after kind of 6 to 8 weeks of persistent defensive leadership in the upper quintile, to me, I thought that was pretty instructive. Especially considering the fact that we have a couple things working in favor of the market. If you think about Omicron and the potentiality for that to to usher in herd immunity, just as a function of how contagious it is, and ultimately how mild it is. But also you have this sort of concept of a convergence trade as well. And what I mean by convergence trade is that the stuff that has gone down a lot has the opportunity to outperform on a relative basis to the stuff that goes up a lot. That's just a function of investors covering shorts and kind of repositioning, and investors. It's more of a valuation driven exercise and not necessarily the start of a longer term macro trend from a market perspective. But it's definitely something that occurs quite often in financial markets that you need to be aware of. So that you're not shorting things that underperform in inflation or deflation at the lows. You're not buying things that outperform in inflation and deflation at the highs. And so that's something we're calling out. And again, that's not just a equity market dynamic. This is this concept of convergence is very clearly being represented across global macro. If you look at our share of confirming markets analysis, we're very clearly starting to see that convergence between the probabilities, the shares of inflation and deflation relative to the shares of Goldilocks and reflation. So net, I think if Omicron is what we think it could be in terms of being a positive economic and market catalyst, you're going to see a lot more convergence over the next few weeks and maybe a few months. So that's something that investors need to be aware of, even though we have this sort of kind of inflation to deflation transition projected. Eventually, that'll get priced in. And then the last thing I'll say on that, getting priced in, is if you sort of look at the chart on the right, I've been saying very consistently, hey, look, I think the poop will hit the fan or start to hit the fan kind of in late Q1, early Q2. And the reason I keep saying that is because if you look at the y-axis on the chart on the right, the chart on the right, that's where we're starting to see the sharpest deceleration. That's where the models project the sharpest deceleration in growth. And as you go back to our back test, our grid asset market back test, it's not the slowing of growth that is the issue. When growth slows modest at a modest pace, you typically have positive returns in equity and commodity markets. It's when growth slows at a more material pace where you start to go from positive returns to deeply negative returns. And so that to me is kind of that is like that's my zone for D-Day of when that might occur. So great analysis, man. Really good presentation, dude. This is awesome.
Yeah, hopefully it's helpful. I know people like visuals. Yeah, I mean, I really appreciate, your research, and, as a professional and also as an individual investor, I use it religiously, and really thankful for all the things you've taught me and over the years, and along with everyone else at Team 42. So appreciate it.
No, I appreciate you, man. Thank you, Mitch. Got a couple questions for you, man. Or so we got, as always, this is intended to be interactive. So let's send as many questions as you can. We'll try to get to as many as we can before the start of the new year. So first question here from Curb Conrad. How you doing, Curb? Says, how did your 60/40 grid portfolio perform during the high volatility regimes? And also, are you often adjusting and trading your asset allocation mix?
Not a lot. That portfolio, you don't trade a lot, and you kind of just let it sit and accumulate and gather returns over time. And, this is actually a good question. So think about this. In March 2020, that portfolio did not do well at all. Like, even the treasury market didn't have liquidity, right? Like, that was at one point when the VIX was at like 70, rates were going up, and the dollar was the only thing that was working. And at my firm at that time, we'd raise some cash, when the Fed dropped rates and we saw the 10-year take a hit. We reduced some cyclical assets, and the Fed moved so fast that it was pretty hard. It was pretty hard to make a decision on, hey, do we put this cash back to work, or are we in a major recession that we need to hold on to cash? And that was a discussion we had for a while. But I like this question. So the answer to your question is no, I don't trade that portfolio a lot at all. Maybe once a year, make an asset allocation tweak or decision. But the reason why I separate portfolios from a beta and an alpha is because it can be really hard to be nimble and to navigate some of those stressful market environments that happen quickly in the 60/40 construct, in the 60/40 portfolio. So that's why I've created a portfolio that, the 60/40, I just let sit. Like my 401k, I just let that sit. In my taxable accounts, I just let that sit and accumulate over time. And you can create alpha portfolios, as a complement or as a bolt-on. Think of it as like a satellite almost to your 60/40 portfolio, to be able to be nimble and to be able to provide that holistic diversification to someone's portfolio. So that's one way that I think about it, is that portfolio I kind of just let sit. But in an alpha portfolio, that even if it's in a taxable account, you can do it the way that you would do it anyways. You just might incur some tax consequences. There's some other ways you can do it too, through maybe the options market. But that portfolio is really used to make the trades and the decisions to offset some of those tail risks.
Absolutely, man. This is great. Craig was asking, it's a outstanding job. He's saying, great job as an RA, subject to tax considerations, regulations, risk tolerance, etc. A lot of what you said today is exactly how he's adopted this our research as well. So, would you be willing to share the slide deck maybe through the I can email it out?
Yeah.
Gotcha. Absolutely. Thank you for doing that.
Yeah.
Kevin K, what's up, Kevin? He says he's asking, can you share any broad ideas, broad areas where you look in constructing alpha portfolios, you specifically?
Yeah, no, I think you can. People are really into the private markets, so people are trying to capture the liquidity premium there. So if you think of like the endowment model, from your alma mater, they try to create some alpha there through the private markets, and just having basic through the endowment model, having basic public equity market exposure. Yeah, I try to do it actually through the options market. That crowding analysis you do, Darius, with the skew versus the implied volatility, discounts and premiums. I'm actually working on a portfolio right now that could enhance your returns maybe through the S&P 500 just through an option strategy using that framework. So selling calls, selling puts, rolling that into something else where you buy puts and buy calls. That's something I'm exploring now that I think could really add value to investors on the alpha side. but yeah, I think a lot of long short, market neutral guys, they try to add alpha, so you could maybe put some of that in your portfolio. But if you're a smaller investor, I think following Darius's portfolio construction and risk management process can definitely help as well. So there's
Yeah,
some thoughts that I have.
and this is something I personally struggle with too. So, like obviously the most of my assets at any given time are following just the plain vanilla 42 macro portfolio construction. But obviously, when you get new money, you get paid and stuff. It doesn't necessarily all go straight into the rebalancing. And I always have cash laying around because I'm a human being who needs to consume money. But also, I have just cash laying around for options and things like that. If I think, oh hey, let me protect for short-term downside protection or things of that nature. Let me, oh, I think rates are going to back up. Let me buy some puts on TLT or something like that. And so my one thing I struggle with is like, okay, how much do I need to do, what percentage of cash do I need to have on hand to allocate to alpha strategies like that? And full disclosure, my alpha strategies are generally a negative alpha event. I do much better to not be doing that stuff. I'm sure a lot of people who deal with short-term options activity have learned that the hard way as well.
Yeah, no, I mean, something I've thought about is you could have the S&P 500 stocks. You can throw that in, that crowding analysis. When you see things getting out there, if you own 100 shares of one of these stocks, you could sell calls and try and collect, that volatility premium. If you want, you could roll that into something else, buy a call in something else that's farther out, on the outlier on that graph. That's something I'm exploring now. I think might be interesting in the future.
Yeah, absolutely. Good stuff. John's asking, hey, John, does the window of time relative to the potential, oh, does the window of time relative to the potential risk of deflation affect how much additional capital you should be putting in equities? I have thoughts too on that, but
Say that again. Like what?
does the window of time relative to the potential risk of deflation affect how much additional capital we should be putting into equities?
Yeah, I would probably suggest. I'm interested in your thoughts, Darius. I would suggest probably the depth of deflation would indicate how much or how little equity you're going to put in your portfolio. I mean, if we're going to hit, a more shallow deflation regime, I think your equities, probably can have a flattish, probably return. It'd be pretty volatile, but over the long haul, they should be okay. But I think it's the depth of how far. I would suggest we're not there yet. In the cycle, if you look at PMIs and everything, they're starting to flatten out and starting to roll over. That's the part of the cycle where you have an economic cyclical slowdown, where you don't necessarily have a full-on recession or a full-on major deflationary regime. So I would suggest looking at the where we're at in the cycle, where we're at in how deep that deflation regime will be, would decide how much you're going to allocate to equities.
Yeah, definitely. I mean, in terms of going to our great asset market back test, just off the top of my head, like the expected value, the expected return of the S&P in a 0 sigma delta or -1 sigma delta deflation event is somewhere around +8 to +10% on an annualized basis. Whereas if it's -2 sigma, you're talking about down 22, 25%. And so that's obviously a massive, massive swing. And so, if you're talking about the potentiality for generating positive returns in an asset class, especially in a time where maybe other asset classes aren't generating as many positive returns, namely commodities, that's something that you don't need to kind of, dramatically reduce your exposure to. To me, I think the name of the game is twofold with portfolio construction. One, it's the asset allocation. What are you actually long and short, or kind of what are you long, in terms of across the asset classes? But then within the asset classes, are you long high beta versus low beta? Are you long high yield credit versus treasury bonds? Those things, those are secondary considerations that I think the grid framework is really good at, trying to help investors do that. So I don't think we're ever going to find a one size fits all answer to that question. I think every situation is unique. It's different, and that's what part of the reason we've done so much work on the back testing side is to understand, hey, when we get to these particular intervals in time, what does history tell us about a modest slowdown in growth from cyclical peak and expectations? Well, that's all we can really go on, and kind of make our best informed decision from there. Let's get a few more questions before we wrap up here. Uh, so James is asking, or Curb, sorry, Curb says, would you use VAMs to generate alpha returns or the probable ranges?
I don't use them as much, actually. I'm more concerned about, I think I've shared this with you through email, Darius, but I'm more concerned with the portfolio as a whole. Obviously, if every position in my portfolio is positive, then I'm happy, and you can generate some alpha there. But I'm more just concerned with what, I when I do these risk management portfolios, I target a beta based on where we're at in the cycle and in the grid regime, and so I'm not as concerned with my entry points and having a positive return as much as I'm concerned about the risk that's expressed in my portfolio, the factor and style, exposures that are in there. And I've learned that over time. So I think as a younger investor, I was more concerned with the trading, right? And, the ranges and all that stuff. And as I've developed as an investor, I found I'm more concerned with the portfolio as a whole. And I look more holistically at the entire structure more than just one or two positions.
Yeah, I'm the same way as well. You can, I mean, if you have time, I mean, if this is all you do, you're retired or you're an actual portfolio manager, I mean, you certainly could sit there all day, sort of trading ranges and scalping basis points in that regard. And there's no shame in that. I think if you do that well, you can add a tremendous amount of alpha to your portfolio. But the reality is, the vast majority of us don't have time to do that. You have clients, I have clients. I can't just sit here trading my PA all day. I obviously have to crank out a lot of research and get back to folks in my inbox. So I do believe there's opportunities to use that stuff. One way is in terms of the VAM specifically, I do believe that, we're trying to, the global macro risk matrix is specifically designed to allow you to sort of use the VAMs in aggregate. It's understanding what's happening globally to inform your decision making, right? Like, every one of those regimes, those regime probabilities in the share of confirming asset market back to share of confirming markets analysis is effectively telling you, hey, this is where the market's moving at the margin. This is markets. This dynamic is peaking. This dynamic is troughing. You can sort of chase that as well, and that's kind of one of the reasons we've gotten more sanguine in recent weeks is saying, hey, look, this thing looks like it's peaking. This deflation inflation debate going back and forth, it looks like it's peaking, and it looks like we're now actually starting to get convergence. And so, kind of, trying to chart out where that might peak out, using the fundamental outlook, using the kind of the, sort of the more sort of qualitative measures. If you think about COVID, qualitative dynamics to inform our views on that. All right, a couple more questions. Gloria is asking, DD, can you talk more on why we're likely to see more volatility so long as deflation or grid four remains the dominant market regime? Is it just a function of investors rotating out of growth and into more deflation friendly assets? I do believe that is a factor. And I think, as sort of later in next year, whenever we do, in our opinion, get to arrive at that sort of more steeper deceleration in growth, we're likely to see what's likely to happen is investors are going to start to take profits or be forced to take profits in their higher beta risk assets. And that's fine and dandy. But the issue with that is that we clearly are living in market times where there's not a lot of liquidity. And to me, the lack of liquidity, we talked, Alfonso Pecatiel and I talked about this on Real Vision last Wednesday. We'll be on Real Vision again this evening. The lack of liquidity, particularly in the last 3 to 5 years, and how much it's declined. We even saw, as you mentioned, Mitch, impact the Treasury market last
Yeah.
March. And so, to me, I think coming from the starting point of an egregious overweight to reflation and cyclical high beta risk asset exposures for the average investor, the average portfolio, kind of getting back to neutral. That process is historically sort of typically, in a cyclical slowdown in the global economy and the U.S. economy, that process is typically sort of coincided with a 50% retracement in high beta assets relative to low beta assets, 75 to 80% retracement in Bitcoin relative to treasury bonds. Like, if everyone's already, the starting point is they're already long high beta and they don't have enough low beta, and they're already long Bitcoin, they don't have enough treasuries, that process is going to be messy. It's going to be very sloppy. And that, to me, is that's where the volatility can come from a technical basis. But just in terms of like our expectations on that, Gloria, when I say that, I'm really just citing our grid asset market backtest data. So just using the S&P 500 as an example, the realized volatility in the S&P 500 whenever it's involved Goldilocks or reflation is somewhere between 11 and 12%. When it's in inflation, it jumps up to 15%, and then when it's in deflation, it's almost double that in 20%. And so you should expect more volatility in a deflation or inflation regime than in a Goldilocks or reflation regime, irrespective of the market's going up or down. Obviously, the expected value is lower in a modest inflation or modest deflation from a growth perspective, and so a lot of the reason that expected value is lower from a headline basis is due to that volatility. Let's see. All right, one more question here. It says, and James is asking, what's up, James? In your opinion, does the Fed care more about CPI inflation or asset prices? Will they continue to tighten as asset markets fall in valuation as inflation stays above their target? I mean, this is, in our opinion, this is the key question investors have to answer. I tend to watch that on the side that they have boxed themselves into being forced to care more about consumer price inflation relative to asset price inflation as a function of their revised mandate. I mean, so you go back to August of 2020 when they adopted the maximum inclusive employment mandate, and in order to sort of you know justify the kind of easy, crazy monetary policy that they would have to pursue in order to achieve that mandate, they had to change their inflation mandate, this average inflation targeting mandate. Well, now that they're well above even this sort of altered average inflation targeting mandate, they've sort of forced themselves to be materially behind the curve, and that's fine and dandy until inflation becomes a political issue. And obviously, inflation in the recent months has really become a severe political issue. Obviously, it's derailed the entire Build Back Better agenda. In our opinion, is something we called out, going back a few months ago, in terms of its risk of derailing that, and obviously that's coming to fruition as in real time. But it's in our opinion, until inflation becomes, much less of a phenomenon in terms of quashing real incomes, which may not be. It could take a year in terms of getting real incomes to a meaningfully positive level. In terms of all the wage gains we're seeing that are still not keeping pace with inflation. And so that to me that tells you that the Fed, from a political perspective, might be in a box. And next year, it could be a year where the Fed has to choose the real economy, sort of the lower median consumer from an income and wealth distribution perspective, and favor that cohort relative to the cohort that the markets have been so accustomed to them favoring over the last few years, and really since the post-crisis era began, which is obviously the folks who have all the assets. All right. Last question, real quick one here. Some Peter Richard. Hey, how you doing, Peter? Says Didi, when is a good time horizon to act on VAMs? VAMs to me is less of a actionable signal. I think obviously you can trade things that break out or break down in terms of chasing the momentum, or more importantly, reducing your exposure to something that's breaking down, just in terms from a risk management perspective. But I think from a actionable signal perspective, the probable ranges are more important. And typically, what I found is that the problem, the periodicity of the probable ranges is anywhere between 3 to 4 weeks. I.e., if you're the upper boundary of the probable range, by the time you hit the lower boundary and back to the upper boundary, it tends to take 3 to 4 weeks for most asset classes. So this is why I say whenever I'm adding a new exposure to the portfolio construction, that's not at the lower boundary of its probable range, I'm like, hey, dollar cost average. You add yourself about a week and a half, 2 weeks to kind of get to build that exposure up just based on that periodicity. But it's obviously not the same for every asset class, nor is it the same for any one particular asset class at every interval, at every cycle. But just kind of my general observations there. So with that, Mitch, man, really appreciate you. This is an excellent presentation. Send this to me, and we'll get this out to subscribers in the replay. And everyone have a wonderful, enjoy the rest of your holiday season. Have a safe, blessed, and warm and happy New Year. Wishing everybody all the best. And I'll catch you guys back here next week.
Yeah. Happy New Year. Thanks for having me, Darius.
Yeah, of course, brother. I appreciate you, man. Thank you.
All right. Later.